Greetings, I'm MT MADIRE. Today we're gonna focus on the revenue and receipt cycle. We're going to audit the revenue and receive receipt cycle. Here, guys, is the example of auditing the revenue and receipt cycle. The first thing, guys, you must know the sales order procedures in order to audit the revenue and receipt cycle. Ne? And then we're going to focus on the risk at material misstatement at the assertion level. Ne? Then you know that the risk of material misstatement include the risk at the assertion level, the risk at the financial statement as a whole. Remember that the risk at the financial statement as a whole may occur due to manipulation. How? Because in the revenue and receipt cycle, we have the sales person. If the sales person like they receive commission, there's a high risk of salesperson overstating what the revenue, which will affect the risk at the financial statement as a whole because they will manipulate the system. Also, will going to affect the risk at the assertion level because if we overstate the revenue, the assertion occurrence, guys, is going to be affected. Okay, number one, here, guys, it depends with the organization whether the organization sell goods on credit or on cash. Ne? If the organization sell goods on credit, let's say our organization sells goods on credit. Ne? Obviously, we're gonna receive the order from the customer, and then we must check the credit limit to avoid the risk of uh, having bad debts or the risk of granting a credit say to a customer who exceeded the credit limit. Here, guys, I'm going to summarize this system of internal control, ne? Because this is the system of internal control. And then also remember that the system of internal control always, guys, will provide what and a reasonable assurance, not absolute assurance, because there are inherent limitation of the system of internal control. As I've indicated that here, guys, we have the salesperson. A salesperson can make error because when we receive an order from the customer, obvious the sales or the salesperson or order clerk will record the customer order in the internal sales order. There's a risk of errors there. Maybe the or that leg may make errors during recording the customer order. We know as human beings we are not perfect. It's the part of the inherent limitation of the system of internal control. And then they manipulate the system of internal control. They can create a fictitious sales. If we create a fictitious sales, obvious occurrence assertion will be violated because we're going to overstate what revenue, guys. Now, guys, I move to step number two, processing the order. When we process the order, just think about the warehouse, guys. What's happening in the warehouse? In the warehouse, you know, we have the picking leg who's going to use the picking slip to pick what the goods. Then he or she will take the goods picked, and then he'll pack the goods in the box, in the labeled box, because the box must be labeled so we can know, okay, the goods will be delivered where. Ne? After we are doing what? We're going to prepare the invoice. Ne? During preparation, we know us as human being, we can make a mistake if like our system is the manual system, or also it can be a computerized system. You see, but errors always, guys, will happen. There's a risk, there's a potential errors to open, guys, to occur. You know, if it is the manual, we can prepare the incorrect invoice. And then if we prepare the incorrect invoice, guys, just imagine, let's add another session called uh, accuracy, because the accuracy, guys, will be affected. Ne? Let me go down. Okay, now my laptop, guys, is 18. Okay, uh, accuracy, ne? Incorrect amount, amount, ne? Incorrect amount. Let's say when we're preparing the invoice, like we use the incorrect amount, or the price list is not updated. We use the old price list instead of using the updated one. Like the errors that can be occurred. So delivery and process, guys, the security guard at the gate must inspect the goods in the delivery vehicle, and then sign the delivery note as a proof of performing the control activities, guys. Yeah, I just remind you, I know that you know these controls. And then delivering goods, delivery received by the customer. When the customer receive a delivery, the customer will sign a delivery note. After, we're going to record the transaction, guys. And then remember that there's a risk of recognition, guys. Sometimes the risk of recognition, how? Because sometimes the sales can be recognized when we receive the customer from the order from the customer, instead of when the goods have been delivered to the customer. It is where we're going to get the risk of recognition, and then it's going to affect which assertion cut off, because cut off is going to be affected, guys, because we're going to recognize the revenue in the incorrect date. You see, in the order date instead of in the delivery date, when the risk and rewards have been transferred to the customer. Ne? And then we going to do where to recording. In recording, guys, think about the classification, uh, about the journal. Okay, in recording, guys, I said we are selling goods on credit. Obviously, we're going to debit. We're going to debit. Uh, Let me increase my font. We're going to debit receivable. Receivable. We're going to debit receivable. We're going to credit what? Revenue. Ne? Let's say 500, 5,000, 5,000. Is the classification, guys. The classification, check, okay, the transaction have been recorded in the correct account. Here, guys, yes, the transaction have been recorded in the correct account, but it can happen, guys. Instead of debiting receivable, and then we debit what bank, as if we have received cash, ne? Which means it's going to affect what the classifications, ne? How completeness can be affected? The completeness, guys, it can be affected if we understate, ne? If we miss, if something that should be recorded and then is not recorded, ne? And then payment received. When we receive the payment, guys, we're going to update our accounting system, ne? Which obviously we're going to debit what? We're going to debit bank, and then we credit what? Receivables. Ne? 5,000. 5,000. And then presentation and disclosure. Here, guys, we're going to look at the financial statement, whether the transaction have been fairly uh, presented or disclosed, like that disclosed in terms of the reporting, the accounting reporting framework. For example, let's say if we are our organization, we are using IFRAS, we're going to check, okay, the transactions have been disclosed in terms of IFRAS. Yeah, guys, I think this video will help you to obtain a better understanding of how to audit revenue and receipts cycle, guys. Thank you.